Everyone. It's wonderful to see so many familiar faces here, and also just to acknowledge our chairman, our Board of Directors Investment Committee Chair, Mr. Brian Goldberg, our Chairman, Mr. Abu Non-Executive Director, Bongani Razia. Just fantastic to have you all in the room this morning. It's obviously, for myself and the team, an absolute privilege to present these results. We're very proud of them. And I also want to just extend a warm welcome to those joining us on the Spear YouTube channel today. And if we get to the questions side, I'll give a little bit of direction as to where that when we'll kind of deal with those questions. Right, so FY 2026 has certainly been a year that's reflected disciplined execution by a great team, strategic, operational, financial, and investment clarity, and the resilience of a Western Cape-only platform. As a management team, we've been maniacally focused on top-line revenue growth, cost controls, and net operating income growth during the year, while successfully executing on our growth objectives that we set out for FY 26. Just what we're going to be covering during the course of the presentation. As I said, if you have any questions and you're in the audience, if you can just state your name and where you're from, and we'll answer those questions after the presentation. If you're online, you can email those questions into info@spearprop.co.za, and we will answer them after the presentation. Joining me today are two of my executives, Christian Barnard, our Chief Financial Officer, who will share the financial and sustainability updates for the business, and Kim Pfaff-Cog, our Chief Investment Officer, who will share with you how we spent our capital during the year and also recycled some. So just a quick recap. Spear remains the only regionally focused REIT listed on the JSE that exclusively invests into the Western Cape. Our mission, which is very clear, is to be the leading Western Cape-focused REIT, to grow our distribution on an annualized basis, and to operate within the top quartile of our peer group. We are very clear on our operating strategy, and that's to be value investors across the various asset types that we invest into, using asset management initiatives to strengthen our net cash flows, to remain an authentic, consistent, and sustainable dividend-paying Western Cape-focused REIT, to own high-quality commercial, industrial, convenience retail assets within the region that generates fixed income for the portfolio, to prudently and optimally recycle capital on an ongoing basis, to maintain an asset management approach to everything that we do, which results in strong tenant relationships as well as high occupancy levels across the diversified portfolio, and to consistently execute on our smart strategy, and I'll break that down in more detail further on in the presentation. And to also, proximity for us is critical. Being close to our tenants and close to our assets does give us what we believe to be a competitive advantage. And finally, to operate with a strong, resilient, and robust balance sheet, which at any given time can range between 38 and 43% loan to value, with a very strong interest cover ratio, dependent on where we are in the cycle. At our core, Spear remains a high-conviction, regionally specialized REIT. Now, our strategy is simple but deliberate. We own high-quality assets in well-located nodes that are economically robust. We allocate capital with precision and continue to build and operate a portfolio that can perform consistently through every type of property cycle. FY 26 is a clear demonstration of our philosophy and strategy in action. As we continue to grow the portfolio, we are of the opinion that the Western Cape is the investment case for South Africa, and here are a couple of summary points. The Western Cape offers the most defensive and scalable real estate investment case in South Africa, underpinned by governance certainty, semi-migration-driven demand, and sustained economic outperformance. What gives us this level of conviction, taking into account a couple of data points: notable share of GDP. 14.3% of national GDP is generated in the Western Cape, which is just under 681 billion. Now, if you look at what the projections look like by 2030, we should be a 1 trillion rand economy. We are a diversified economy, which is not as reliant on the volatility of a commodity cycle. We've got the lowest unemployment rate in South Africa, 18.1%. And anecdotally, over the last 5 years, 9 out of every 10 people employed in South Africa were employed within the Western Cape. The Premier has a quote where he says that nothing stops a bullet like a job. and that really is the case. If you look at the economic outperformance within the Western Cape, if you look at the labour force participation rate, we've got the highest labour force participation rate in the country at just under 70%, which means that there's more people participating in the active economy from a jobs perspective, which puts more money in people's pockets, which they get to spend in our shopping centres, which they get to buy from our factories, and they get to rent office space from us. We've got the highest household income in the country, about 407,000 Rand per annum. And why is that important? It's important because we've got a growing population, both within the Cape Town, and within the Western Cape. 5.2 million people living in the Cape Metro at the moment, and about just over 7 million people in the Western Cape. By 2030, that should be 10 million people, which means that people need to live somewhere, and that creates growing residential nodes, which creates retail opportunities for us. People need to work somewhere within those nodes. Given the cost of transportation, you'll find that some decentralized nodes will become stronger and stronger, like the northern suburbs in Tiger Valley. We believe will continue to outperform, and as you see where vacancy rates are. And again, even provincially, again, we see the entire province from an infrastructure perspective as a great investment opportunity. We've got a diversified future-facing economy. If we look at the types of economies we find in the Western Cape, financial services, technology services, business process outsourcing, tourism, services sector, which is very, very well diversified, which is a great moat around the province. The city of Cape Town, it is the urban economic engine of the Western Cape, contributes 71% towards provincial GDP. This is certainly a metro that spans 2,500 square kilometers that does exactly what it intends to do, service delivery, as well as growing the investment case for the city of Cape Town. We'll be spending 40 billion Rand over the next 3 years on additional infrastructure. When you count to the Western Cape compared to the rest of South Africa, very much more a structurally resilient province compared to the slightly weaker macro in South Africa. If we look at energy, we look at water, especially in the last week or so, we've got an economy that is very much performing above the benchmark in South Africa. So as mentioned, these are some of the data points as to why we seek to only invest in the Western Cape, just given the provincial underpin, the governance certainty and infrastructure investment. So we'll continue to do that, and we see the whole of the Western Cape as an investment opportunity for Spear, even Robben Island. Right, so now moving on to the highlights. One of the highlights of a phenomenal result for us for FY26 is that at the middle of May last year, we guided 4 to 6% growth in our distributable income per share. We've exceeded that growth to around 6.02%, which is really just a fantastic achievement by a committed and dedicated team. That translates into a distributable income per share of 90.70 cents. We apply a 95% payout ratio to that, which is 86.16 cents per share. Our portfolio within the Western Cape has expanded over the year. We acquired 3 high-quality Western Cape assets across the strategic asset types that we invest into at around 1.08 billion. That added 137,000 square meters of additional high-quality GLA to the portfolio, generating an average return to Spear shareholders of 9.54%, which is well ahead of our cost of capital. Having a look at the portfolio at a glance, if I just look back over the last 2 years, we've really been incredibly blessed to have the growth opportunities we have. The portfolio is at a value of 7.18 billion, which is just under a 30% growth compared to the prior year, which is really fantastic. High-quality assets, 42 in total currently, with across gross lettable area of 630,000 square meters. We've generated strong operational performance. Our weighted average lease escalation is still above 7%, and our occupancy rate has continued to improve to just over 97%. Our weighted average unexpired lease term, these are some of the tongue twisters that we now have to deal with in terms of the new disclosures, is basically the period upon how long our leases still have to run. That's 30.28 months. Now, if I look back where we came from out of COVID, where we said our priority was tenant retention and rent preservation, we would be willing to renew leases on slightly shorter terms because we could see potential future upside opportunities. We are now reaping the benefit of that, where we've worked really hard in getting that weighted average unexpired lease term, closer to the 36-month strategic objective that we set out as a team. Rent reversions were slightly negative on a renewal and relet basis, but positively, the core portfolio generated a 6.02% positive rent reversion on renewals, which tells us that from a property management, asset management, and a leasing management perspective, the team did exceptionally well to get that level of growth out of the renewal part of the portfolio. And on the counter to that, the slight negative reversion is something that we planned for within our forecasts and was able to be absorbed without impacting the financial performance for the period. Our balance sheet remains primed for growth. It's exceptionally well managed at a 22.94% loan to value. Interest cover ratio very robust at 4.34 times, and we remain highly liquid with available cash prior to our raise at 382 million rand. Our cost to income ratio at 45.36%. Our property cost to income ratio at 38.55%, and our admin cost to income ratio 6.86%. Our CFO will unpack that in more detail as we hand over to the financial presentation shortly. Collections remain strong. I think it's the old adage that cash is king, and that is when you look at the cash flow that we generate as a business after covering all our costs, very strong at 96 million, with a cash collection ratio of just under 100% year to date, end of Feb. If I look at our PV strategy, this will probably be the first, call it, reporting year where the acquisition of the Emira portfolio, we implemented the PV rollout, and you'll see that in the revenue generation, in the net operating income contribution that the PV portfolio made to the overall portfolio. 27 assets with solar infrastructure, 2 systems currently under construction. Those will be completed between Q1 and Q2 FY 2027. And as I mentioned, 31.3 million rand revenue contribution, which is around 4%, generating around 21.8 million towards our NOI. Then having a look at our tangible net asset value. As it stands at year end, 5.38 billion. That translates to 12.91 rand per share. We raised 749 million in new equity in June 2025, which was really well supported by our shareholders. We also concluded a 152 million rand Section 42 asset for share swap, which was the acquisition of the Berg River Business Park in Paarl, giving us around 430 million gross shares in issue. So moving on to the corporate performance. If I just look at for the first bars, if you have a look at your total return, assuming that you reinvested your dividend, over a 5-year period, we generated a total return of 32.19%, over 3 years, 31.64%, and over 12 months, 46.52%. Now, effectively, if I take up to December 2025, we outperformed every other asset class in South Africa as a company. If I take up to the end of Feb, we did not outperform equities and we didn't outperform gold. But for everything else, so I reckon we've set a bit of a gold standard for our business. Then again, liquidity. If I look back from 2016 to 2026, liquidity certainly has been a journey for us. Some days were less encouraging as others, but I really believe that in FY 26, our liquidity came of age. We have, as I mentioned, 430 million shares in issue. We traded more than 25% of all shares in issue during the year, which translated to about 1.2 billion rands worth of shares traded. And already FY 27 looks very much like it's going to outperform FY 26. And that was also largely contributing to the inclusion in the SA REIT index and the All Property Index on the 23rd of March, where funds that had the mandate to do so were able to pre-position themselves in the correct manner to take advantage of the index inclusion and the potential upside that would come from that. Then just having a look at more granular detail in terms of the portfolio overview across the retail, commercial, and industrial subsectors, which are the core pillars of our investment strategy, investment philosophy. On retail, around 80,000 square meters of retail GLA, and will be growing later this year as we take transfer of Watergate in Mitchells Plain. Occupancy is strong at 97.56%. Collections, equally strong at just under 100%. Reversions, pretty much flat on total renewal and new let. Renewal reversions ahead of inflation at 4.30%. In-force escalations, 6.61%. This is an area where we're also looking to try and push those escalations back up to above 7%. And with the acquisition of Maynard Mall during the year, that came in at a slightly lower average escalation rate, which obviously, given its scale, did push that average down a little bit on retail, but we don't see why we can't get it back to where above the 7%. And also, just talking about Maynard Mall, we successfully onboarded it. The interest from nationals to generate more tradable area within Maynard Mall has been really welcoming, and we do believe that there's some additional GLA and non-GLA upside that we can generate out of that asset in the near term. Just in terms of commercial, around 127,000 square meters of GLA, occupancies are just under 93%. We also had great momentum during this year, generating good leasing momentum within the commercial office space. Collections, as I mentioned, just under 100%. Reversions were negative 6%. Now, I don't want to kind of skirt around this issue, but the reality is that rents don't always go up. Sometimes rents do either go sideways or go slightly down. We don't shy away from it. We budget for it. We plan for it. And when it does eventually happen, we mitigate it by re-tenanting that space as quickly as possible to reinstate the cash flow. On renewals only, you can see the leasing team did an exceptional job at 4.54%. Our in-force escalations, robust at 7.23%, which is fantastic because if you look at our average expiry profile, you'll see the compounding benefit that we get out of that escalation on an annualized basis. Then looking at industrial, which is certainly the cornerstone of the portfolio, 422,000 square meters of gross lettable area. Occupancies, 98.6%. Collections, equally strong at 99%. Reversions, positive at 2.14% in totality, renewals and new lets. Renewal reversions, very strong at 7.84%. In-force escalations at 7.11%. And very, very proudly, we've broken ground in George, and we will also be breaking ground in Blackheath in August, which again will add organic NAV unlock to shareholders going forward. And the sustainability link project at Mega Park is anticipated to be completed by the fourth quarter FY27. And just having a look at the sectoral split by value, revenue, and GLA. I've spoken about the valuation on the portfolio, but what you can see here is a well-diversified portfolio where reliance is placed from an income and revenue perspective in the right subsectors within the portfolio. We went to great effort to create that kind of equilibrium effect between commercial, industrial, and the kind of upside or upswing in retail from a revenue and GLA perspective will be seen on an ongoing basis as we move through the year. Just breaking that down even further, the industrial portfolio is valued at 3.1 billion across the 422,000 square meters, strong occupancy rate at 98.6%, contributing 337 million to group revenue across the manufacturing, urban logistics, and mini/multi-let industrial units. Commercial, 2.5 billion in value across 127,000 square meters. The occupancy rate strong, but there is room for improvement, contributing 316 million towards the revenue for the year. Then in retail, for the first time in FY26, we breached R1 billion plus in our retail portfolio with the acquisition of Maynard Mall. That takes, obviously, doesn't take yet into account the Watergate acquisition, which will bring us closer and closer to a 2 billion rand retail portfolio, which we think is a fantastic result because we really have been patient in making sure that we buy the right asset at the right price, because we also believe that you create value not just when you sell the asset, but actually also when you buy the asset. In terms of revenue contribution, slightly lower than many of the other two subsectors at 156 million, but that will certainly scale over the next year or so. Our rent to turnover ratio is 9.28%, our trading density at just under 3,000 rand a square meter per month, and our effort ratio 10.35%. Now, we believe that all three of these metrics perfectly align and are very much in line with where we want to be, because these assets are what you call high volatility commuter convenience retail assets. Therefore, we believe that these metrics all align with the standard we want to set. Then just having a look at the letting activity for the year. We had 157,000 square meters come up for renewal and relet. We relet 156,200 square meters at an average rental negative reversion of 2.28%. On renewals only, just under 60,000 square meters came up, and we relet pretty much just on 60,000 square meters at a positive reversion of 6.02%. Our tenant base is extremely diversified, and that also is defensive in nature. If I look at the 630,000 square meters of GLA that we own, approximately just under 613,000 square meters is occupied, which is a 2.72% vacancy rate. Now, if you drill it down, obviously we want to do even more and better work in the office portfolio with 9,000 square meters vacant, industrial 5,600, and retail 1,965 square meters. This is as at the end of Feb, and some positive inroads have already been made into some of these vacancies, which we'll delve into in the half-year interim results. We've got 659 tenants within the portfolio, and you can just see here the general makeup of the portfolio tenants. As I mentioned earlier, lease expiry profile. This is a very benign lease expiry profile with about 19% of our renewals and leases coming up annually. So effectively, we've got 81% of our leases that continue and roll for that 30-plus months, which is very defensive from our perspective. And also, I'm pleased to note that the expiries that look at March 26 to March 27, for the most part, those have all been already mitigated at a very early part of the FY27 year. Right, so I'm going to hand over now to Christian Barnard, our Chief Financial Officer, to take us through the financial performance. Thank you very much.
Morning, everyone. I promise I'll try and speak slower. Thank you, Sue. Again, our financial information looks simplistic, but it is complex in nature. So we'll take you through highlights, but please send in questions, email, and we'll delve into the detail as needed. Looking at our income statement for the year, we grew our revenue to 840 million excluding smoothing, which is 23.25% ahead of the prior financial year. On a like-for-like basis, that's 23.54%. But some interesting information about the like-for-like. Generally, like-for-like is defined by assets held at each financial period end. But in FY25, we acquired 13 assets from Emira, which we only held for 4 months. So now that's 4 months compared to 12. So now if you only compare 12 to 12 months held assets, our like-for-like is still at 6.7% growth, which just shows you the strong performance from the core portfolio. Strong escalations, low vacancy. So the core portfolio drives the business and allows us to make acquisitions and drive further growth in the portfolio. Now, our NOI grew by 20.53% for the year. And as Quintin mentioned, our cost to income ratio is a total just about 45%, and operating costs just under 40%, and admin costs just above 6%. Now, as we are a growing business, there's always pre-implementation costs. So we are not afraid to perform at these numbers because we know there's staff we need to employ, there's costs we need to, offices are growing. All of these costs are pre-run acquisitions. So these costs will smooth line into the portfolio in the future as we continue to make acquisitions. And unfortunately, Kim is very busy, so she gives me a lot of work to try and manage these costs. You will note that furthermore, our net interest for the year reduced by 7%. That is a result of interest rate reductions, but also continuously having improved margins in our debt portfolio. Now, all of this performance resulted in an ICR of 4.34 times, well above our covenant of 2 times. Then looking at our BPR, the best practice recommendations, now we are very proud to announce that we have adopted the 2025 BPR, which was announced. It's not, you do not have to elect to adopt it now, but we as a business believe in strong governance and in strong reporting, and we elected to adopt it. So all the information you see in our financial statements are based on the new best practice regulations that is published on the REIT website. As Quintin mentioned, 90.70 cents per share for the DIPS, applying a 95% payout ratio, giving us total dividends per share of 86.16 cents per share. 95% payout ratio has been a consistent number for us over the past years. It will continue to be, as we believe retaining that 5% is prudent for further upliftment and improvement of a portfolio. As our core portfolio continuously needs repairs and maintenance, continuously needs capital improvement, and we do have sustainability projects we are underway to make sure our portfolio continues to perform at a strong and high level. Now, one very interesting fact about the new BPR is that in the new regulations, depreciation allowances relating to assets is not allowed to be added back to increase your distributable income per share, a motto which SPIE has followed since its inception at listing in 2016. We've continuously faced questions, why don't you do that? Why don't you increase dividends? And we've stuck to our guns, and finally it's written into the regulations that it's not allowed to be done, showing why we've done it, because that depreciation relates to tenant allowances and commissions, which continuously needs to be incurred to ensure the portfolio is at the highest possible occupancy that it can be. So we're very proud to report that numbers and show that we continuously are actually leaders in what regulation should be. We will be declaring a 44.57 cent final dividend for the year, which also we will be declaring a dividend reinvestment program as of this morning, which further details will be announced on SENS, and as well as the circular being posted out later today. Then our balance sheet. It's always been simplistic, but now it's even become more simplistic. We've done some cleanup in the financial year. As Quintin mentioned, 7.1 billion rand of assets. Our assets, our investment property held for sale, we just announced the sale of the Hamilton Chapini, which Kim will delve into more detail. And then maybe if you look at it on the right-hand side, in our financial liabilities is now at zero. During the financial year, we had some free cash from operations, so we decided to settle all the solar finance lease liabilities. Those assets were running at IRRs of 18 to 24%, so it made 100% sense to settle all those liabilities and bring 100% ownership back to the company. All of this resulted in a tangible net asset value of 12.91 rand, which grew from 12.20 rand. Now, these slides give you a bit more detail of how our NAV grew from 12.20 rand to 12.91 rand. During the financial year, a credible performance in our core portfolio as well as new acquisitions resulted in fair value adjustments, which resulted in a 1.11 rand increase in our TNAV for the year. The Section 42 acquisition had a very small decrease, as we announced in SENS when we did the acquisition of Burger River Business Park. The capital raise we concluded of 749 million. We will never forget that 1 million that we didn't raise, as mentioned by our deputy chairman many times. It resulted in a small decrease. At the end of the financial year, it's resulting in 12.91 rand, showing once again how we continuously asset manage our portfolio to drive NAV growth for our shareholders. Now, the bottom graph, our LTV sensitivity. This is a very important graph. At period end, our LTV was at 22.94%, well below a covenant of 50% as set by the banks, and even well more below the JSE requirement of 60%. Now, these numbers we put out here is a 12 to 24 month bridge of what is to come and what we are planning on doing. Now, as a management team, we only put information in here which we believe is highly likely to occur. So there's information we cannot yet fully give details to, but I mean we are working diligently to further grow the business, and with a 22.94% LTV, there's a lot of room for growth in this balance sheet, in this portfolio. Just after year end, we concluded a multiple oversubscribed capital raise, which reduced our LTV. We announced the acquisition of Watergate Retail Centre. There's a couple of due diligence underway, which is keeping us very busy, and we will hopefully announce by interim results. We have our final dividend to be paid, the disposal of Hamilton and Chapini, which will reduce it, and as well as Blackheath Park, which construction will begin in August. And we have the George. There's still some top structure works that needs to be started, and civils works to be completed that coincides with the top structure as it goes on. Now, concluding all of these transactions, if we conclude every single one of these transactions as of today, our LTV will still only be 25.54%, meaning we are still well below a strategic band of 38 to 43%, just showing you how much room there is for growth in this portfolio. Our debt. Then here we thank our valued partners that always contributes towards our debt portfolio. Our total debt of 2 billion, of which 71% is fixed at the average cost of 8.75% at the weighted average expiry of 31 months. Variable debt at 29%, average all-in cost of 8.2% at the average expiry of 40 months. Now, as we always explain to the market, the two charts in the middle and the right-hand side, these are the two. So your debt has variable debt. You then overlay fixes and swaps over your variable debt always. 2 billion is your net variable debt, of which 1.4 billion is fixed at rates. We have a robust maturity profile. You will see that we have no near-term refinance risks. The debt that is in short-term has a term that's already been agreed, and we are busy drafting the legal agreements. So I see someone is sitting here, he needs to be working hard on those agreements. Then in terms of, we refinance just under 500 million rand of debt in the new financial year, of which one is a refinance of a sustainability linked loan. And then, as Quintin mentioned, net of allocating capital, we have 382 million of cash reserves, net of all construction, development, portfolio improvement capital allocated. So we are ready to grow. Balance sheet and funding update. This is just a confirmation of our covenants, and that we are well below our LTV and well above our ICR. Then on the right, you will see the incredible work that we've done in the current financial year to increase all the weighted average expiries and actually lower the average cost, resulting in higher dividends and more robust maturity profiles. So this is the slide you take a screenshot of and send to all your friends and to show the business how well we've done, also for them to invest. This is a highlight of the majority of the financial information in the portfolio. This will give you the information that drives the decisions we make in the financial year and what we've achieved in the financial year. So I will not delve into this. This is just for you guys to celebrate with us again. I didn't press any of those buttons. This thing is moving by itself. Why is it doing that? Okay. ESG. Now, the last interim reporting, we obviously had a massive solar rollout and expansion portfolio. So in the last 6 months of the FY26, a significant amount of work was done in the solar portfolio. Together with our installation partners, Emerging Energy and asset managers, Matriarch, we've managed to conclude all but 2 of our solar assets, one which has been concluded after year end, the other one which is in the planning and introduction phase. So at period end, we had 22 owned assets, 5 of which roof rentals, 2 capex projects, which one has been completed. We've taken the approach of now only developing our solar assets by ourselves and putting capex into it rather than having further roof rentals or finance leases, because the returns are just so substantial in the portfolio, resulting, as Quintin just said, 4% of total revenue in the past financial year, which we anticipate to grow to between 5% and 6% in the new financial year. Our penetration rate is at 24.01% at year end, projected to grow to 26.98% in the new financial year. Our target in the near term is to achieve a 30% penetration rate. We believe that is a sustainable number, as we do have very high power manufacturing properties, which requires power, which is practically impossible to provide a higher penetration rate, because these tenants are very tech savvy, they are smart. Some of them produce at night, which we obviously can't provide solar then. They just have the demand of power is just too high. It doesn't matter how much roof space you have, you cannot implement enough solar for their power demand. But it also embeds them into your portfolios, because we have the availability power coming into these parks that they require, which there are very few of in the Western Cape. So, as Quintin mentioned previously, 31 million revenue generated of solar, which is projected to exceed 40 million in the new financial year, generating an NOI of 22 million rand, which equates to just above 5 cents in terms of actual DIPS for the portfolio. Then, a sustainability update. I know it's very difficult to see on that picture, but the executives are among the very young students there. We all look the same and young and energetic. But this is something we are very and incredibly proud of. This business has grown to a point where we were able to launch our very first bursary program. We're sponsoring 3 very incredible and talented individuals from UCT studying the honours in property studies. We launched this program, and it was so fulfilling to hear the stories of these individuals, the studies, the ambitions, and we are looking forward to further actually sponsor more students in the near future. And as they conclude their studies, they will have the opportunity to do internships at Spear under the guidance of Kim, being a registered property valuer, which they are studying towards, and she will guide them into being the young new professionals into the industry. We also have 2 students studying, internal students studying accounting studies, which we sponsor. We have 4 employees that is on 12-month managerial programs, as well as studying of providing support for a very individual from Women's Property Network. So you can see we are very passionate about supporting the youth of South Africa and creating further development. And as this business grows, we hope that these numbers can only expand and more individuals can benefit from this Spear success story. Throughout the year, in terms of ESG and governance, we adopted King 5 fully into our integrated report, which will be released on the 29th of May. We adopted the REIT best practice of 25 and into the 26 financial numbers. We improved our BE rating from level 8 to level 6, which we are very proud of, as well as refinancing 230 million sustainability linked loan through Standard Bank. Then on the right-hand side is some of the organizations that we support. And I highly recommend you look into these organizations. And if you have some money in your hearts, spend it with them. They are doing incredible work, and we will continue to support these and continue to look for other charities that we can support throughout the financial year. I know it was fast, but we are running out of time. Kim.
Thanks very much, Christian. Good morning, everybody. I'm going to be taking you through our capital allocation and portfolio activity over the period. I'm going to take you through acquisitions, disposals, then our property developments, and finally ending off with our property valuations. But before I get into the presentation, our capital allocation strategy remains disciplined and cycle aware. We continue to allocate capital into assets that we have conviction in the underlying node, the income profile, and importantly, our ability to enhance the value of the assets over time. At Spear, our strategy is straightforward: buying better, selling smarter, and developing selectively. This approach continues to underpin not only the quality of our portfolio, but also the consistency of our income. That said, I'm going to move on to our acquisitions already concluded during the period. The three acquisitions that we concluded, firstly, we have Maynard Mall in Wynberg, Berg River Business Park in Paarl, and Konsani Industrial Park in Goodwood. Collectively, these acquisitions represent approximately 1.1 billion rand of strategic capital deployment into well-located, defensive, good quality Western Cape assets. I'm pleased to report that occupancies remain strong, income performance is stable and it's growing, and we're already seeing positive operational efficiencies across the assets as we integrate them into the Spear core portfolio. These acquisitions reinforce our industrial and our convenience retail positioning in line with our investment strategy. Moving on to our post-year-end acquisitions and disposals. Post-year-end, we were very excited to announce the acquisition of Watergate's shopping centre in Mitchell's Plain. This is a dominant convenience retail asset, approximately 20,000 square metres, and as you can see from the image above, excellent quality, very well looked after property. It is anchored by a high-performing ShopRite and a Brights Hardware. Approximately 75% of the gross lettable area is underpinned by national tenants. We acquired Watergate Centre in Mitchell's Plain for 442 million rand at an initial yield from the date of transfer of approximately 8.4%. Importantly, while the lease expiry profile is relatively short, we view this as an opportunity rather than a concern. It gives us the ability to actively re-gear the income profile and potentially look at some tenant mix opportunities over the next few years through our hands-on leasing and asset management initiatives. Overall, Watergate is exactly the type of defensive, cash-generative retail asset that we want to own in the Western Cape. This transaction is still subject to Competition Commission approval. We have our filing is already in, and all things being equal, we anticipate it will transfer around August this year. And then on to disposals. We haven't announced a disposal for some time. We've been very busy with our acquisitions, but last week we announced the successful conclusion of Hamilton and Chiappini House. I can confirm these are not houses, as one of the articles did report last week. They are in fact commercial buildings. They formed part of the initial transaction we did with Emira, the 13 assets we acquired in October 2024. They're contiguous. You can see they're commercial buildings with some retail at the bottom, and they're located in a very trendy area in Cape Town called De Waterkant. Now, this is a node that is increasingly characterized by residential conversion activity. As such, we took the opportunity to strategically on-sell these assets at a 33% premium to what we acquired them for. And this will result in generating a profit in excess of 26 million rand for Spear. This is a great example of how we continually look for opportunities to unlock value for shareholders. Moving on to our development growth. We continue to make disciplined progress across our development pipeline. Firstly, we have GTX Park in George. Now, this is our development opportunity directly opposite the George Airport. We have now received our first approval to commence with a 5,000 square meter multi-let light industrial building. We always said we'd like to pre-let the space before commencing construction. However, we found that given the nature of the inquiries in George, which are typically between 500 and 1,000 square meters, these types of tenants like to commit between 3 and 6 months before taking occupation. Thus, we have, as an executive team, taken the decision to commence construction, and we're confident, given the number of inquiries and the nature of inquiries, that we will tie those leases up during the construction phase. And this is a very important milestone in establishing the precinct and marking the commencement of the first phase of GTX Park, which in total will be around 30,000 square meters of industrial. And then we have Bravo Park, which is the extension. You may remember this is the opportunity at one of our existing facilities known as Bravo Park, where we can develop a 7,000 square meter warehouse. We knew it wouldn't be long before we secure a suitable tenant, which we have now done on a 10-year lease. The plans have been approved, and we expect construction to commence in August this year. And then last but not least, we have the Anchorage on Marine Drive in Pardon Island. This is our large-scale mixed-use development opportunity. The project is currently in its final stages of design, development, and feasibility. We are making excellent progress, and we're actively engaging with a seasoned co-developer on this opportunity. But importantly, there remains no pressure on Spear to develop prematurely. Our rights are firmly in place. The property is completely and fully income producing, and we will only move forward when market conditions, the transaction structure, and our co-developer or developers are appropriate, and it's in the best interest of Spear and our shareholders to do so. Across all of these developments, our approach remains disciplined, protecting the balance sheet and bringing the projects online at the right point in the development cycle. And finally, turning to property valuations. This is also one of my favorite areas of the business, and I really believe it is the core of the health of any REIT. I'm very pleased to announce we've seen another excellent result in our portfolio. Over the past 6 months, we've seen an uplift in our net asset value of 365 million rand, equating to around 5.42% in just 6 months. This growth is supported by strong underlying operational performance, together with something that I was very surprised to see, the implementation of our solar across the portfolio has added really nice, resilient, additional income to our portfolio. And then, of course, the resilient property fundamentals in the Western Cape. You'll notice external valuations have increased to 96%. I think this may be one of the highest percentages we've had. I have been very busy, but it also, what it does do is it strengthens the independence. I don't want to say credibility, because our numbers are very credible, but it strengthens the independence of our numbers. And then looking at the rate per square meter, per sector, you will notice that in each sector there's a firming, and especially in the industrial portfolio, again, it's certainly the star performing sector. Looking at the average value per property, you will notice that each of the sectors, we're well above our minimum investment threshold of 100 million rand per asset, which really does reinforce the institutional quality and the scale of our portfolio. As we always say, our approach is less is more. We'd prefer to own fewer assets, but assets of higher value. Looking at our valuation assumptions, as always, they remain conservative and broadly stable. Important to note, at Spear, and for those of you who aren't familiar, we do not value any bulk in our portfolio. After the acquisition of Maynard Mall and Consani, we've increased that bulk. We have over 140,000 square meters of additional bulk, and that is not yet represented in these numbers. And it represents significant upside for our shareholders as and when we choose to develop the bulk. Overall, the portfolio remains appropriately valued and well-positioned in key nodes in the Western Cape. In closing, from my side, the portfolio is in a strong position. Over the past year, we've improved quality, we've strengthened income, we've recycled capital effectively, and we've remained disciplined in how we allocate our capital. This positions Spear well for long-term continued growth without stretching the balance sheet or chasing risk. Thank you very much. I will now hand over to Quintin, who will provide you with our guidance.
Thank you very much, Christian and Kim. That was really well presented. Thank you. Okay, just... Right, so Spear is entering FY 2027 certainly from a position of strength, both operationally and financially. This is driven by the FY 2026 guidance outperformance, a declining cost of capital, a robust and growth-ready balance sheet, Spear's inclusion in the SA REIT index and the All Property Index in March certainly will add to improved liquidity, as well as the ongoing expansion of our investor universe. Our portfolio is, as Kim mentioned, quality and highly defensive, and the strategy is to maintain strong lease covenants and also a strong tenant base over this next year and into the long term. And we'll continue to grow the Western Cape portfolio in a consistent manner in key nodes that we've identified as growth nodes for the business. FY 2026, when you look at it in the rearview mirror, and FY 2027 looking forward nicely out of the windshield, you'll see that the acquisitions will underpin income growth, earnings growth, subsector diversification, and strong capital appreciation prospects. When we look at our growth pipeline, FY 2027 has already been a busy period for us. We do anticipate a growth pipeline of between 1 billion and 2 billion rands worth of yielding income-producing assets coming into the portfolio during FY 2027, which we are very excited about. But in addition to that, as Kim mentioned about unlocking that value for shareholders, we anticipate about 140 million rands worth of high-quality industrial assets coming on stream into the portfolio, one of them being in George, in GTX Park Phase 1, Building 1, and the other, the Blackheath Bravo Park expansion of the new modern distribution facility, which equates to around 90-odd million rand. We are very fortunate that we'll continue to operate in an area known as the Western Cape Advantage. We believe that the provincial economy will continue its outperformance as these strong economic fundamentals are maintained. The benefit of a lower unemployment rate and the higher rate of semigration will continue to also drive the investment case for us into other nodal opportunities. And then, as always, we'll maintain a strategic focus. We'll remain long-term investors with a disciplined approach to investing. We don't suffer from hurry sickness. We don't have to build a 20 billion rand business in a year. We'll build strategically and we'll build with intention. And also we'll build to create a business that actually can live to 100 years plus, which will outlive most of us in this room, possibly not our CFO. We'll continue to align with the provincial agenda, which is that of the Western Cape Provincial Government, the City of Cape Town, and the many local authorities that we continue to invest into and work alongside, which really does create a very enabling environment for us to make capital allocation decisions in an area where you know that the infrastructure is there, the infrastructure is reliable, and the infrastructure will continue to be looked after in the years coming. And lastly, we'll continue to deliver sustainable dividend growth and total returns to our shareholders on an annualized basis. Now, every year we set out key strategic priorities. This year will not be any different. In terms of FY 2027, we've set out 6 of them, and that's to unlock organic value within the portfolio through activation of embedded portfolio bulk, which will again enhance shareholder NAV. We buy well, and we develop high-quality assets within the core portfolio, unlocking that embedded bulk. There'll be targeted asset growth. We'll pursue yield-enhancing acquisitions that yield to us ahead of our cost of capital. Our leasing performance, we'll continue to strengthen that with a maniacal focus on reducing our vacancies on an ongoing basis. There'll be disciplined cost controls. We can grow our top-line revenue as much as we want, but if we cannot control our costs, we're going to be going backwards, and that really is a key focus. We'll drive sustainable platform growth within our business through the strategic acquisitions, but also through an ongoing and authentic prioritization of our ESG strategy, and we'll continue to invest into best-in-class human capital. Now, I mentioned earlier at the beginning our smart strategy, and this really is our business in action, which is a consistent execution of this smart strategy, which is to specialize in the Western Cape. We have no desire to invest anywhere else. Our management will continue to be conducted internally. We can kind of feel the pulse of the business when it's racing and when it's not racing fast enough. To do accretive acquisitions, there's no reason to just grow for the sake of growing unless we can grow meaningfully. To redevelop portfolio bulk and unlock NAV for shareholders, and to timelessly execute on our early engagement leasing strategy, which has been a core hallmark of Spear since inception. Just having a look at our guidance, based upon the information that we have available at this point in time, we anticipate to grow our distribution per share by between 6% and 8% for FY 27 compared to FY 2026. And subject to board approval, we anticipate to maintain a payout ratio of 95%. Like most things in life, these are subject to qualifications, so please just familiarize yourself with that. It's not fine print, it's the same font, so it's easy and it's clear to read. Minimal load shedding during FY 2027. Our vacancies are reduced in line with management's forecast. Our lease renewals are conducted in accordance with our projections. We've got no major tenant failures, which I'm pleased to say at this point in time we don't foresee any. Tenants will continue to absorb increased cost of occupancy, which is becoming an important factor for every single tenant. Any shift in monetary policy will be able to be absorbed within the business, within our forecast for the year, and no civil unrest will occur in Cape Town, the Western Cape, and South Africa. Thank you very much. That brings us to the end of our presentation. If you have any questions, please, now will be a great time to ask them. So what we'll do is we'll maybe ask the questions that have come through on the website first, and then we'll go to any questions in the room. Thank you very much.
Okay. Question from Trinity at Anchor. Congratulations on the strong results. FY27 DIPS guidance seems moderate. Could you provide some color on the key assumptions underpinning the FY27 guidance? Specifically, does guidance model and include any equity capital raises? To what extent does the guidance incorporate further acquisitions beyond already announced or acquired? Should I take it?
Yeah.
So equity raises we do include, but unfortunately the equity raise we did do now in April was done after results were already in motion and in print. So those obviously will be the impact of that capital raise we did in April will be further assumed and adjusted into our guidance we put out in either our Q1 update towards the end of June or in our interim results. And in terms of the acquisitions we never include into our guidance purely because there's one element we can't control, Competition Commission approval. Sometimes we get it quickly, sometimes it takes a lot longer than we anticipate, so it makes it difficult to include it in. We know what the numbers are, but when to include it into our results is the timing factor we need to be. So we want to be moderate and conservative and not announce it's going to transfer and then we have a 3-month delay, which we have seen happen before. So we don't want that to go into the market prematurely. Alistair Anderson from Property Flash. You speak of liquidity coming of age. Who is investing in Spear that hasn't before? Is greater liquidity attracting large institutions?
Yeah, I think when we talk about like the investor universe expanding, for the longest time, Spear was not in any index, which meant that there were mandate restrictions placed on shareholders that could not invest into our business. Many that wanted to, but just were precluded from doing that. So typically, we've seen many larger pension funds, both kind of public and private pension funds, come into the register, which has certainly acted as a strong underpin to the growing business going forward.
Then a question from Peter Combridge. Given the tight spreads in the bond market, is there any appetite to launch a bond program? Yes, there certainly is. At this point in time, we're working diligently with the financial institutions to investigate this. And if you don't believe me, one of them are here who keeps presenting to us, so you can ask them. But at this point in time, we believe we have to grow a little bit more. We have to free up some unencumbered assets, which we are diligently working with the banks. So in time, yes, it will happen. But at this point in time, we believe it's anything from 12 to 24 months away from becoming a reality for Spear. Another question from Peter. There are 2 Nedbank facilities. Peter, don't target me. There are 2 Nedbank facilities maturing in November. What are the value of these facilities and what are the progress with regards to these refinancing? So the value of those facilities in a gross basis is just under 500 million, and the terms have already been agreed. And as I mentioned, the legals are being drafted for refinancing. So it's basically being concluded already post year end. Nothing further on email. I'll check again at the end.
Do you have any questions from the floor? There is a mic. Abe? Yeah. Do you want to maybe just grab the microphone there? Thanks.
Abe Gordon, private. Just like to make a comment and maybe a question. Listening to your presentation today and observing the rise of your gross assets from 1 billion over the years to 7 billion now, you're rightfully proud, and your management should be very proud of you.
Thank you.
Progress. Looking at the future, and I'm not sure I heard the answers clearly, but you raised 700 million this year. What dictates your pace of raising funds in the future? And having grown to 7 billion and knowing that you want to grow at least to 15 billion soon, what are the big challenges? I mean, for example, there are changes going on in property, or interesting changes like data processing, the new airport in Durbanville. I know it's difficult to take advantage while you're trying to keep your yield as high as it is, but maybe you could make some comments.
Sure. Yeah, so I think maybe on the first point, what has characterized our growth since inception is that we've always only raised what we needed. So when we did the raise in June, we raised 749 million. We had a clear strategy with those funds, and also we were very specific as to at what rate we were willing to raise it. I think one of the hallmarks of this business also is that we don't get remunerated to grow. We actually get remunerated to grow in terms of asset base. We get remunerated to grow the income of the business. So in terms of a balance sheet prime for growth, we typically will bring acquisitions to a point where we know that we can kind of raise the equity, but it's never a case of just sitting back and thinking, well, listen, the ducks are quacking, we're going to just kind of throw equity at the market. We've been specifically very stingy with our equity. And again, just that flows into the type of credible, predictable, and consistent results and operational management of the business we've done over the years. We've set specific targets in terms of FY 2027. And again, the capital we raised in April, again, is aligned with that kind of raise what we need, not necessarily just for the sake of raising. Because also, if you sit like right now, if we don't have a plan with that capital, we could be accused of having a bit of a lazy balance sheet. And we're also very sensitive to creating unnecessary cash drag on the income statement. So that does determine, and also the pricing. At the end of the day, when we are able to, warehouse the cash for a period of time at a pretty much a neutral kind of cash management perspective, we'll do so, and then we'll deploy. As Christian said, the Competition Commission does add a layer of kind of complexity and delay to be able to deploy that capital. So we've got to be very careful in terms of what we raise and when we raise it. And then, sorry, just in the second point, we're a REIT. So we plan on paying a dividend consistently every 6 months. So taking large land positions as an example from what I kind of make from your question isn't necessarily the type of staple that you'll find in our business. We've always said that 80 to 85% of the growth of this business will be driven by income-producing assets, acquiring industrial, commercial, convenience retail, mixed-use opportunities that are yielding ahead of our cost of capital. We do take land positions in areas where, as an example, in George, it's the second fastest growing city in the Western Cape. There's undersupply of high-quality industrial, and we were able to acquire the agricultural land and take it through the entire value-add process. But let me tell you that your kind of life cycle of development is infinitely longer versus in terms of getting it to a top structure. So therefore, a smaller percentage of our business will be kind of organic-led in terms of development growth versus acquiring investment grade and investment properties that are generating a yield from day one. Because development is risky, landholding is risky, things can change, objections. You might find a frog that you never knew was there, which could delay your development for 15 years. So these are also things that we have to do from a risk management perspective to ensure that our shareholders are protected from the downside risk of owning too much land. And equally, there's drag that gets created because the land isn't productive at a specific point in time. It takes quite a while to start generating cash flows. Cool. Thank you. Any other questions? Okay, so we're standing between you and a good cup of coffee and the photo wall.
So one more from Alliston is always of a left field question. We can count on that. Are there any outstanding portfolios you would consider buying, like the Emira one you acquired?
So the bottom line is that we consistently looking at investment opportunities, whether it's a portfolio or a standalone. There's many things. You look at if you just pay a bit of attention to the LTV bridge, you can see that there are some forthcoming attractions, but we don't want to spoil that for anybody, and we also don't want to get in trouble with the regulator. So you'll have to just watch the space and see how things develop. Thank you, everyone.
Quintin,
please join us.
Sorry, everyone. Sorry for interruption. As you guys might not know, this is the 10th year of Spear being listed. 15 years ago, 3 individuals founded this business, and over the past 6 months, there's been a couple of people working very diligently hard to create a memorabilia piece for Mike, Quintin, and Abu. If you please bring it up for us. We worked very hard to create a coffee table book for you guys. Included in this book, would you please come up there, please? Included in this book is messages from shareholders, friends, family, including every single asset you guys have transacted with, both acquired and bought, with pictures, asset values, GLA, timeline, history. And from all the staff and people, we can just say thank you.
Wow, thank you very much. Thank you very much.
Now,
Thank you. Thank you.
now you can conclude.
Yes, and also Christian doesn't just work in subtractions, he also works in additions. So also want to just congratulate Christian and Joni, his beautiful wife. It's also here. They'll be welcoming their second child in the next couple of months. And we also just wish you all the best for that. Thank you, everyone. Please join us outside for a drink and a chat.